All right, interest rates, mortgage rates, and employment. Those are the three topics I'm going to discuss today as we head into 2025. So interest rates are in a very interesting spot right now because you have underlying weakness in the economy, but then you also have some inflationary pressures starting to bubble up. The biggest one being the weakness in the Canadian dollar, because the U.S. remains stronger than most other countries around the world. The U.S. dollar remains very strong, which is increasing the interest rate differentials between the U.S. interest rates and other countries like Canada. And as the interest rates differential increases, which is the spread between U.S. rates and Canadian rates, it makes parking capital in the U.S. more attractive. So money moves south of the border, therefore the Canadian dollar depreciates. As the Canadian dollar depreciates because of this effect, we start to import inflation, because all of the imports that we bring into Canada, we're having to buy with a weaker currency, which makes them more expensive to us. And therefore, the importers have to pass on those increased costs, which then causes inflation. So the weakness in the Canadian dollar causes inflation, which then brings us to the Bank of Canada and interest rates. They see the weakness in the underlying Canadian economy, so they want to continue to bring down interest rates, which is the forecast. However, as the Canadian dollar starts to plummet, they're going to start to reconsider how much they can actually cut interest rates here in Canada. Because at some point, the weakness in the Canadian dollar is going to start to overpower the weakness in the Canadian economy, and we're going to start to see inflationary forces take hold. So the weakness in the Canadian dollar is actually a limiting factor on how much the Bank of Canada can cut interest rates. So keep that in mind. On the employment front here in Canada, I came across an article in the Globe and Mail this morning with an interesting study that shows the change in employment here in Canada since February 2020, right before the pandemic set in. And as you can see here, a lot of the industries and sectors are now actually lower than where the job numbers were for that sector pre-pandemic. And you can see here as well, like how much they increased after the pandemic. They went up a lot, and they've actually reverted a lot. So this just goes to show you that the employment in Canada is not strong. And if you think about it, Canada has added 3.5 million people. The population has grown by that much since February 2020. 3.5 million people have come into Canada, and the employment sector, or the employment in Canada, has not changed. It's unchanged. So there's 3.5 million more people and the same amount of jobs as there was 4 years ago. So not good for employment, not good for people getting jobs, not good for people earning income and being able to pay off their debts. So as you can tell, this is a bad situation for the Canadian economy. So wrapping it all up, when the Bank of Canada is cutting interest rates, if the market thinks that the Bank of Canada needs to cut by 1% and they only cut by 0.5%, that's not going to be inflationary, and the fixed rates, which are based on the bond market, are not going to move higher, because the bond market is saying, no, you still need to go another 0.5% before I think there's going to be inflation. So the fixed rates will continue to move lower with the variable rates. However, once the market believes that the Bank of Canada has cut enough or cut too much, then the fixed rates are going to start to move higher. Complicating the situation is the Canadian dollar, as I talked about earlier. It is also inflationary. So as the Canadian dollar is moving lower because of the interest rate differential, that complicates the Bank of Canada's job. So as you start to see fixed rates move higher, that is the market telling you that the Bank of Canada, combined with the currency devaluation, has gone too far. But until then, it's telling you that the Bank of Canada can cut some more. Right now, the fixed rates are kind of moving sideways. So that means the market's not really sure whether or not the Bank of Canada, combined with the currency devaluation, has gone far enough. I guess we'll have to wait a little farther to see if the Bank of Canada has cut too much or if it needs to cut some more. Take care.